Hello everybody and welcome to this video entitled The Most Undervalued Growth Stocks in My Coverage Universe. And I haven't done this video in almost 2 weeks, so this is probably a well-needed update, but I do this video typically on Fridays, although I didn't want to wait this time, so you get the video on Tuesday. And if you're used to this video, feel free to just pause and look at my valuations updated as of today. And if you're not new to the video, welcome to the channel, and let me tell you a little bit about what I do here on this channel and my style of investing. So what do I do on this channel? If you're new to the channel, this channel is focused exclusively on growth stocks and really hyper growth stocks, what most people would consider hyper growth stocks. Like, for example, a Google, technically a growth stock. I'm not very interested in Google because it doesn't grow fast enough for me. My minimum threshold for a stock to be included in my coverage universe is 30%. It has to be growing revenues at more than 30%. Why is that? Because I want to double monetary inflation. 15% compounded over 5 years, that's a doubling in 5 years. That's a 4x in 10 years. These are good returns that I look for. But you can't get those returns only with 15%, because if you only get a nominal return of 15%, your real return, in my view, is 0%. You need a 30% growth rate in order to get a 15% real return. And that has to do, of course, with monetary printing, M2, and how much new money is getting issued year after year after year after year. So on this channel, I try to focus on real returns, not nominal returns, not returns that make you feel good when you look at them in dollars, but don't make you feel that good when you look at them in terms of purchasing power. And of course, I define that very differently. That's why the channel is named Beat the Denominator, by the way, because I'm trying to beat the denominator. Everything is divided by the number of US dollars out there, and I'm trying to beat the growth of how many US dollars are out there. Now that I put that out of the way, let me tell you a little bit more about the spreadsheet. So, for example, I focus on enterprise value. One of the reasons why I focus on enterprise value and not market cap is because I want to penalize companies that have a lot of debt. I also focus on gross profit. None of these companies are optimized for earnings, and some of them are not optimized for EBITDA, actually. And because they're not optimized for that, I try to get into the sweet spot of companies that are just optimized for gross profit. And I judge them only based on gross profit. And this is linked to my style of investing, right? Earnings matter if you're a value investor, but I'm not a value investor. My style of investing is investing in adoption curves, adoption S-curves. You've probably seen this chart before, but the whole idea of my style of investing is I try to find companies that sell products that are just on the verge of getting adopted. Products that say have crossed that 5% threshold, right? If it's 3, 4%, or 6, 7%, that's the ideal spot that you want to buy a product when only 5% of the population knows that this is a great product. And you want to ride it all the way through technological adoption. And then you obviously want to sell once the product has been adopted by 70, 80% of the people. That's what you want to sell. And typically with innovation, that's a 10 to 15-year process. So all of these stocks that you see right now, I consider them either early on that process or either perhaps in the middle of that process. If you look at my e-commerce stocks, we're in the middle of adoption of e-commerce, right? But if you look at electric cars, for example, when I cover Tesla later, Tesla will definitely early on, early adopter, right? 4% market share is what Tesla has. Electric vehicles have about 6% market share. So we're right at the beginning of adoption. So that's why I love Tesla, because in my view of the world, electric cars are going to be everywhere. In past 2033, in 10 years, electric cars are going to be the main mode of transportation. That's going to be 90% of all of the sales. And of course, there's going to be a big S-curve adoption, right? And the exponentiality is the beginning of the S-curve. That's right here. That's the exponentiality that you get for all of these products. So because a lot of these companies are, by definition, early on, you will find that they tend to be a little controversial, right? A lot of traditional finance investors don't understand them. A lot of value investors definitely don't understand them because it's early on, because it's right at the beginning. These companies are not part of the consensus of investing yet, but the products are getting adopted, which is why I cover them. And the last thing that I'll say in this spreadsheet is the number that matters the most to me is this number, enterprise value over gross profit over revenue growth. Why does it matter so much to me? Because I want this number to be very small as possible, preferably under 0.5 is something that I would consider to be an inexpensive stock. If you see this calculation, you'll find it to be very similar to Peter Lynch's PEG ratio. The PEG ratio of Peter Lynch, very popular in the 80s, had a lot of benefits for identifying growth stocks and really modifying the valuation that you give to a stock based on its expected 5-year growth rate, right? Based on its expectation of growth. But Peter Lynch was doing it for earnings. Now, I believe in the companies of the 21st century, earnings are not the same as they used to be in the industrial era. Today, if you look at a company like Amazon, extremely powerful company, very little earnings, right? Earnings don't mean what they used to mean, right? Today, it's more strategic factors, strategic metrics that are used to analyze and assess the success of a company. That's why these companies can reinvest every year, reinvest their profits and show very little earnings. So that's why I care mostly that they break even. As long as from a free cash flow perspective, there's no bankruptcy risk and the company breaks even. I am not overwhelmingly seeking earnings. Earnings to me, it means you're kind of running out of money to invest in and your product is not getting adopted anymore, if that makes any sense. So that's why I've modified the metric, and it's not the PEG ratio anymore, it's the enterprise value over gross profit over revenue growth ratio. If you follow the PEG ratio, you know the PEG ratio under 1 is considered undervalued. For this spreadsheet, like I said, the lower the better. But under 0.5, I would argue in general, from years of using this method, under 0.5 is excellent. And so now that we've gotten that out of the way, we can tell which growth stocks is the most expensive. Which stock out there are you overpaying for growth? Are you overpaying for growth, for revenue growth, for any of these stocks? That's what this question answers. And so you can see, like spoiler alert, but just looking at it, you can see, for example, that Nvidia, you're paying a fortune for every single percentage point of growth. But there are stocks that you're paying very little for growth. And these stocks are, in my spreadsheet right here, HIMS, StoneCo, and Lovesac. Lovesac is just a very tiny position for me. I'll get into it later. But HIMS and Stone are about equal size, but they are much bigger positions for me. And if you look at a stock like HIMS, you're paying almost nothing for that growth. You're paying a 0.06. I mean, this is a company that has recurring revenue that is growing at above 50%, 80% gross margin, more than 1 million customers. I'll get into it a little later in the video. And it's trading at a 0.06. So this stock to me is dirt cheap. And I can say the same thing about StoneCo. StoneCo is dirt cheap. It's a payments company in Brazil. It's the quote-unquote Square of Brazil. Is dirt cheap. And Lovesac is dirt cheap based on my spreadsheet. And one could extend that and really say anything under a 0.3 is going to be pretty darn cheap in here. Like anything under a 0.3, like Teladoc is cheap too. What else? Figs is cheap too. What is it? Nubank is pretty cheap. So there's a lot of cheap stocks here. Like the greener it is, the cheaper it is. Now moving on to my expensive stocks. What are the most expensive ones? Well, you have Nvidia right here. Nvidia is quite expensive at a 2.81, followed by Shopify. Shopify has been a high flyer. I mean, we had a little bit of luck about 9 months ago when the stock dropped, but it's flying high again. Expensive stock, and it probably has to do with Canada, I think. And the last one is the Trade Desk. Trade Desk is also expensive, right above 1. So now that I've gone through the cheapest and the most expensive, now that you may have paused the video and looked at the spreadsheet for whatever stock you own or you like, let me go through each of those groupings of companies because I've put them into groupings. And by the way, what you see here, energy revolution, healthcare, data warehousing, etc., these are all the mega trends. So I try to look for stocks within mega trends, right? Trends of adoption like this. I tried to look for stocks within mega trends. So the first mega trend is what? It is energy revolution stocks. I'm covering on this channel. There's many of them, and if you watch my solar videos prior, you see I cover a lot of solar stocks on the channel. But there's three that come to mind that I follow and that I own. I own all three of these, although STEM is really, really a tiny position because it's such a small cap and it's a risky position. So I own less STEM than Tesla. Tesla is my number one position. Enphase is my number two position if you just look at stocks. Enphase is actually number three if you have Bitcoin, because I have a bigger position in Bitcoin than Enphase. So Tesla and Enphase, my two top stocks. What does Tesla do, right? Tesla is an energy revolution stock. It's all about the transformation of energy from internal combustion engine and anything that has to do with oil and gas in general to electricity. And why is that? Electricity is more efficient, it is cheaper, it is better, it breaks less, and you can make it with solar. So there's so much going on with electric vehicles, and to why electric vehicles are so good. Electric vehicles are getting adopted. Tesla is such a multifaceted story, but in a nutshell, if I were to summarize Tesla is a bunch of 0 to 1 moves in a single company. A single company is having more than 5, off the top of my head, 0 to 1 moves. And by that I mean, so for example, fueling a Tesla, right, it's going to be under $10 of electricity. Fueling a gas car, depending on what you have, under $70, $80. All right, so you're almost at a 10x right here. Then the car drives itself. How many times is it better that the car drives itself, right? Then if you look at everything that has to do with the safety, how much better is it the safety for a car like a Tesla? They pride themselves on safety. If you look at things like charging at home and not having to go to the gas station anymore, right? Most owners of EVs don't go to gas stations anymore. They just charge at home for cheap. How much better is that? How much better is the experience of charging in your garage at home versus charging at a gas station, right? Gas stations are not a cherished experience. So if you look at Tesla is really a bunch of 0 to 1 moves in a single company. That's why it's my biggest position. I think the better way to look at Tesla is to look at it like you're buying multiple companies in that sector. And they are obviously the giant gorilla in the sector with an $800 billion market cap. But I would argue it's not that expensive considering the potential of Tesla. And of course, if they were to solve full self-driving, that valuation would go through the roof. It would, it would not even be funny. Then we'd be in trouble if you have a big position in Tesla, because it would probably quickly be 80% of one's portfolio. So, anyways, not investment advice. Moving on to Enphase. So, Enphase. And Tesla, by the way, has a big solar division, but Tesla is such a huge company that it doesn't even move the needle. It doesn't even move the needle for Tesla. Enphase is a pure play in solar, more specifically microinverters, i.e. the most important part of solar equipment, which is the inverter. It's the little box that you put under your solar panel that turns your electricity from DC to AC. And that little box is great because it can scale, and you can sell a lot of them, and you can they're about to sell about 10 million run rate of them, 10 million of these little boxes that cost about $130 or $140 per box per little microinverter. And so they are a near monopoly in the microinverter market. They pretty much invented the space, and they are a leader. They're also a leading supplier of microinverters, and now they're moving towards a more holistic view of residential solar and offering other products such as tracking software, such as batteries, such as EV chargers. They're offering a whole bunch of products now, Enphase. And Enphase is really, I would argue, part of a duopoly right now with SolarEdge. And SolarEdge is the main competitor, but SolarEdge still uses a legacy technology called string inverters. So anyways, that's the idea behind Enphase. I've done a full analysis of Enphase. I think it's a fascinating story, fascinating stock, if you want to look at it. STEM is an installer of megapacks. So it's funny, I told you Tesla is a conglomerate. Here's another thing I haven't mentioned about Tesla, right? They have a megapacks. Megapacks are growing at more than 100% a year. So these megapacks that are typically for industrial applications. Like a major plant, for example, a factory. You manufacture stuff. You get a mega pack. That mega pack allows you to store your own energy, to buy energy from the grid when it's cheap, and use it when the grid charges you more for your electricity. It allows you to have very large solar installs and store your energy for yourself. It is to me the future. And what STEM does is STEM installs these megapacks. STEM is a major installer of both Tesla megapacks and Chinese copies, essentially, like Chinese megapacks. And STEM has its own software. Tesla also has its own software. So essentially, Tesla has a significant business that competes against Enphase, and has a significant business that competes against STEM, and probably has a significant business that competes in just about every single segment of the energy revolution. But if you're looking for pure plays, I believe Enphase and STEM are interesting pure plays in the battery space for STEM, and in the solar inverter, the microinverter space for Enphase. And that's the energy revolution right there. Moving on to healthcare. So healthcare is going through a revolution of its own as well, and that revolution is digital. That's the fact that brick and mortar, right? We don't need brick and mortar banks anymore. We don't need brick and mortar retail anymore, right? E-commerce, neobanks or e-banks. We don't need physical healthcare anymore. If you look at the data, right, you need a building to do diagnosis and diagnoses, but if you follow what both HIMSS and Teladoc and that whole space says, about 70% of our healthcare needs can be done through your phone, through an app on your phone. You don't need to drive 40 minutes to the doctor and wait 3 months and wait in a waiting room where other people are sick. Who thought that was a good idea, by the way, to have waiting rooms to see the family doctor? But this is all this issue with legacy business versus first principle thinking. Like first principle thinking, it's obviously so much better to see the doctor on your phone, right? You're not going to get contaminated. Nobody's going to contaminate you. It's going to be faster. The doctor is always going to be available. You're never going to have to wait because the doctor does not have to be in your local city, right? It can be on the other side of the US. There's a lot of power behind this revolution of healthcare. Anyways, I have two stocks in the revolution of healthcare, two different approaches. HIMSS is preventative healthcare. That's how I define HIMSS. They focus on providing healthcare before it gets to actually a really bad issue and you have to get like a surgery or oncology treatment or anything like that. So HIMSS places itself very early on, tries to capture customers before they have major issues. That's why they focus on minor issues, things like hair loss, things like ED. And these minor issues HIMSS treats. So what you do, HIMSS is a mix between an e-pharmacy and an e-doctor. So you get the app, you get in front of a doctor, the doctor prescribes or does not prescribe something that's appropriate for your condition, and then you get it in the mail through their pharmacy. So they have vertical integration going on, and HIMSS operates fully outside of the insurance system, which is why I believe this is a company that has a potential to grow much faster than a company like Teladoc, which operates within the healthcare system and within the health insurance system, and which is thus constrained by growth at, I think, the pace of legacy healthcare and the pace of red tape. So, and there's a whole bunch of fundamental reasons why I also believe that healthcare in the future, the more advanced we get in healthcare, I believe the fewer things are going to get reimbursed, and the more and more people are going to be willing to pay out of pocket for minor healthcare issues, which is why I love HIMSS. HIMSS is preventative healthcare, and I think they have a lot of things going for them. Not to mention they are dirt cheap right now. Dirt cheap. So let me move on to my data warehousing stocks and data monitoring stocks. I have 4 stocks in there, and by the way, these are SaaS, right? These are all SaaS stocks. HIMSS, I could call it a SaaS business model. It's very similar to a SaaS business model. And my cybersecurity too, they are going to be SaaS business models. So software as a service. What we mean by that is that you don't sell a piece of software and then try to sell version 2 3 years later. No, you just get a subscription, and the subscription business model is just an outstanding business model because you get the predictability. You get to see to have vision in the future. You get inertia installed in the business where once you get a subscription, most people, once they get a subscription, they keep it for a decade plus. This is why these businesses are powerful. Moving on. Okay, so Datadog, Snowflake, Palantir, and MongoDB. Datadog, what is Datadog? Datadog is an infrastructure monitoring app. What it does, it allows you to monitor your cloud infrastructure, your data infrastructure, your entire IT stack. You can monitor with Datadog, such that if there is ever an issue, let's say there's been a customer order something and there's a big issue somewhere, they didn't get what they needed, an engineer can go and use Datadog and see where something that went wrong across hundreds of different apps that the company may use. So Datadog, because of that, has a very specific niche in its business model. It is data. It is major data, and it's actually stunning the number of data points that they analyze to find issues. The company is growing very fast, 25%. That growth has abated a little bit because there's less corporate spend right now. Gross margin is outstanding, as you would expect from a SaaS business, 72%. The stock is a little expensive right now. All of these, by the way, are a little expensive right now. Snowflake, what is Snowflake? Snowflake is a cloud data warehouse or data lake. More people call them data lakes today, but it's your data in the cloud. So companies, instead of storing their data in their own servers, they can now store it online in a cloud agnostic way. So you don't need to run software on, say, AWS. No, you have this different system that works with everything, where you can store all of your data all at once. Snowflake is very interesting because they could potentially be a threat to APIs, or at least revolutionize APIs with data sharing, because they allow companies to share data directly. So if you have two companies and they're both customers of Snowflake, they can share their data together through their marketplace. And I believe this is very promising for Snowflake. They also have a very interesting pricing model, and it is the cheapest stock in my data warehouse stock, in my data universe. I think it's important to note that Snowflake has a private competitor in Databricks, and we will get more info once Databricks IPOs, and to try to really compare the two. Snowflake is more really stage one of data. It's more legacy data, while Databricks is more really like AI type of data or AI analysis. So Snowflake is more accessible. They're also known for having a good interface, being more accessible. Popular CEO, the CEO of Snowflake, Frank Slootman, is known for having a lot of success at ServiceNow and at other companies in the past. And so this company is heavily followed, but very expensive. But that's okay, because we're all expensive in this space right now. I mean, we had so much luck 6 months ago when we were cheap. Third one is what? Palantir. So Palantir, right now, the stock is getting expensive. I own Palantir because of a military business. I think they are the uncontested leader for military AI software with their Gotham platform. And it seems like they are resonating a lot right now with companies with their AI foundry business, because we've entered I guess I'm going to call it that, the quote-unquote hype cycle of AI. And of course, if we're in a hype cycle for AI, obviously Palantir is going to be right at the heart of that, along with other companies in AI like Nvidia. And so this stock could have more room to run. Nonetheless, still own it, mostly for the military business. I think it's a fascinating company, part of the PayPal mafia, right? Founded by Peter Thiel, friend of Elon Musk at PayPal. Fascinating stuff. And the CEO is a very interesting man. If you've never watched an interview about the CEO, I recommend you watch it and really ask yourself what you think of Alex Karp. Very interesting guy. Heavily followed too, like Tesla. Just like Tesla, Palantir has a huge following online. Okay, moving on to MongoDB. So MongoDB is very simply it's a NoSQL database, and they run this database on their system called Atlas, and Atlas is very popular among developers that are keen to use NoSQL, because there's a whole trend of people who don't like SQL, and because of that, the company is doing fairly well. The growth rate is great at 28%. And the gross margin at 73% is as you would expect for a SaaS company, which is crazy to say that we would expect 70% margin, but it is that good. I mean, the business model is that good for this type of business. Moving on to cybersecurity. So, cybersecurity, we live in a digital world, right? Security guards at the front of the store, that's the job of the past. The job of today is security guard in your edge, at the edge of your network, right? Wherever you do your transactions, whether you do your transactions on your phone or on a laptop or on a car, doesn't matter. A distributor doesn't really matter. You need to have cybersecurity now on all of the devices that we have, and I have three main players in that intangible digital space of business, right? We don't do business in retail establishments anymore. We do business in a dematerialized, IT-driven, IT-forward way, and for that we need cybersecurity. There's three stocks in cybersecurity that I like: CrowdStrike, Zscaler, and Cloudflare. So, CrowdStrike. What is CrowdStrike? It's endpoint security. You set it up on your device. Most often it's going to be a laptop. It could be a phone. You set it up on your device, and it's a network of devices that are all connected. Whenever you have a breach on, say, a laptop, CrowdStrike, being in the cloud, learns of that breach and then prevents that breach from happening to all of the computers on the network, right? So if you had 1 billion computers, and one computer was breached, CrowdStrike could signal that there's been a breach and could update and prevent other computers from getting infected. CrowdStrike is perhaps one of the more ultimate business when it comes to network effects, and it's a very powerful company. Inspirational CEO, had a meteoric rise to 33 billion. If you ask me, very impressive. Growth next 4 quarters, 39% is what analysts estimate. Gross margin, excellent, as you would expect for this type of business. Moving on to Zscaler. So what is Zscaler? So let's remember CrowdStrike, right? CrowdStrike is endpoint security. So Zscaler is what they call themselves the castle and moat model. But what Zscaler does essentially is it prevents an infection into a laptop to get to the network. So if a laptop is infected because it's a new virus and CrowdStrike didn't catch it because it's brand new, Zscaler is here to prevent that virus from infecting the rest of the network. So zero trust, it's called zero trust. Zscaler, zero trust is what they pioneered. Why is it called zero trust? Is because your device can't connect to another device without going through the Zscaler software, which will protect further spreading of any infection you get on a laptop. The last company, and by the way, Zscaler and CrowdStrike are the two companies that I would consider adding to right now. Cloudflare, I would not consider adding to right now. I find it too expensive. I mean, if you look at it, they have roughly the same gross margin. They grow slower than CrowdStrike and Zscaler, but the valuation is almost double. And what Cloudflare does, though, in case it gets cheaper someday, we don't know what can happen. They can miss earnings or something. What they do is they are what I like to call a VPN for website. So they hide the website to anybody who logs into the website. You don't know the server. You don't know the server that company is using to broadcast their website. And because you don't know the servers, you don't have any surface attack. So they hide you. They hide corporations and their servers from the public. That's what Cloudflare does, and they are the leading company in this space. Moving on to another mega trend. Another megatrend is e-commerce. So e-commerce, as I was saying, when I go into my adoption curve, it's likely that e-commerce, we're like right here. It's likely that we're in the middle of e-commerce, in my view. E-commerce, I believe we may have 5 more years of enjoyment investing in e-commerce, but it's becoming very widespread. It's one of the earliest disruptions out on my spreadsheet that you see here. So what does Well, we all know what e-commerce is. Obviously, what company do I have in e-commerce? All right, so I wouldn't have Amazon, for example, because Amazon is too big. It's too developed. But you can see these companies are already pretty big. We have 3 companies here: MercadoLibre, C Limited, and Shopify. Let me get Shopify out of the way. Shopify is a very expensive company. What Shopify does is stunning, actually. They power just about everything e-commerce that could be needed for a lot of standalone corporation. Actually, Figs, that I'll cover later. If you look at Figs and what Figs sells, right? They sell scrubs. It's a lifestyle company. They are powered by Shopify. They use Shopify to sell their products, to sell their stuff. So Shopify is holistically speaking, it's an enterprise resource planning system for selling stuff online. They do everything for you to sell stuff online. They even have a feature if you want to open some stores. I mean, it's they're doing really well. It's a leading company in its space, and it's a company that in some sectors is giving a run for its money to Amazon as far as retailing goes, which is also why the valuation may be high. The downside to Spotify, in my view, is that it's a very expensive company. I think that has a lot to do with the fact that a lot of Canadian shareholders buy Spotify, because it's one of the few stocks out here who is not American. Nonetheless, I think it's too expensive. I think they still have an avenue for growth, but I would not touch it at this level. Then we have C Limited and MercadoLibre. So C Limited is a company that is doing really well in Southeast Asia, mainly Indonesia. They have two big divisions that I like, which is their Shopee division, which is e-commerce, right? And they have a popular e-commerce website in Indonesia. And they have their C-Money division, which is a fintech, which is also fairly popular. On the other hand, they have a gaming division that is still on the decline because they had the most popular game, Free Fire, that got banned in India and is getting banned here and there still today. And so they are the reason why the growth of C Limited is a little slow is because of their gaming division, who has seen its revenue more than get halved in about 12 months. So it's really the problem. MercadoLibre is my favorite in the e-commerce stocks. MercadoLibre is a Latin America player. They're very big in Brazil, but not only. They're in Mexico, they're in Argentina, they're in Chile, and MercadoLibre is kind of the real deal. They have a lot of things going on. Their e-commerce website is the leader, but it's not all they have. They also have a successful fintech division. They have a successful logistics division. They have a successful, still launching, but somewhat successful right now, advertising division. So this is a company that has the playbook of Amazon without the cloud. So keep that in mind, because Amazon without the cloud would be valued way less. But it's a company that is doing very well, that has exhibited consistent growth since 1999, and I believe, like I said, that could continue perhaps 5 years until we really get to saturation when we look at e-commerce. So older companies in e-commerce, nonetheless, fascinating mega trend. Let me move on to my payments stocks. So I don't have a lot to say about my payments stocks. DLocal and Square both got attacked by short sellers, and it also doesn't help that for some reason short sellers seem to love to hate on payments. And because of that, I haven't added to these positions, but I'm just staying on the sidelines and looking at what's going on. I did find both of these short reports for DLocal or Square to not be very good. But I rarely find a short report to be very good. And perhaps I should make a video about why I don't find short reports to be very good. Because, as a short, you have an incentive to find something bad about the company, and then you just short the stock, and then you release your report. It's not my favorite style of investing. It really is not. I do not like short sellers. I do not like short selling, and I think it's just upsetting that companies have to spend scarce attentional resources to defend themselves in front of short sellers, as opposed to just focusing on the business. And if you follow that, people spend a lot of time, CEOs, top management teams spend a lot of time responding to accusations. Anyways, company that hasn't been attacked by a short seller is StoneCo. StoneCo is a great business. It's owned by Cathie Wood and Warren Buffett alike. Warren Buffett likes when StoneCo is a good value. Kathy Wood likes that StoneCo is a fast-growing company. The reason why StoneCo is so cheap is because they had a collateral issue back in 2021, and the market has entirely dismissed them because they lost hundreds of millions of dollars, and it's punished the stock by almost 90%. And the stock still hasn't recovered, even though they fixed the issue. So we're in a situation now where StoneCo, we have a stock that has been forgotten by the market, whose growth continues to impress, whose products continue to be essential to the small business makeup in Brazil. And they are really the story of the Square terminals, but in Brazil. That is the story of StoneCo. They have one competitor, PagSeguro. I believe the market is big enough. Brazil is a huge country compared to the size of that company, right? It's only a $4 billion company. To me, this market is good enough for them to have a very, very long growth runway going forward. I am happy to own StoneCo. It's one of my bigger positions in here, along with, say, HIMS, Datadog, Crowdstrike, Zscaler, etc. Moving on now to chip makers, and moving on to very tiny positions this time. So chip makers, I'm fully sold out of Nvidia. What can I say about Nvidia? Let me just start by saying that Nvidia, yes, it's a stunning company. Did I make a mistake selling Nvidia 7 months ago? I very well may have made a mistake. I very well may have made a mistake selling Nvidia 7 months ago. The problem is that if you're not an insider of these chips, right? I think I've said that before in my videos, but I think a gamer, someone who's been a gamer for 10 years, who's loved these chips, who has seen the progress every other year, someone who has waited in line in front of Micro Centers for 2 days to get the latest GPU, I think they would have had the insider knowledge or the insight to hold Nvidia. I just don't have that insight to trust that valuation. And it's very likely a mistake. I very likely should have not sold it, is what I'm beginning to see, because obviously the exponentiality in AI is absolutely stunning. Now analysts are predicting 27% growth again. So it turns out their slump in sales was really temporary, and now it's picking back up as companies are scrambling to get their hands on these $10,000 A100 GPUs to set up in their data centers to get their large language models running and over recommender systems and all of the good stuff that AI does. So because of that, Nvidia is the leading company, and yes, Nvidia is better than AMD. If you compare the presentations of Nvidia and AMD, yeah, you can see that AMD is playing catch up. Now, what I like about AMD better, and that's why I always say perhaps AMD, and I have a tiny position in AMD now. I've been selling off AMD because I also don't get those valuations as much. AMD seems to be a secondary player in the GPU space, and the GPU space is, of course, what you use to do your large language models and to do your AI, right? That's what you use. AMD, on the other hand, is doing really well with CPUs, and they're beating Intel in the CPU space. The problem is, you need 2 CPUs for every 8 GPUs you sell, so it's a much smaller market. I will say a few more good things about AMD, though, is that they are diversified, right? So they do gaming consoles, they do embedded electronics, what they call. So, for example, like the entertainment systems in Teslas, that's run by AMD's. They do a bunch of stuff. They're a diversified company. I just find them a little expensive at a 0.83, given that they're not the leader. Like, I don't have a problem paying 0.83 or even a 1, but you have to be the leader, right? Tesla is a 0.81, but they're the absolute leader in their space. AMD is trading more expensive than Tesla per my valuation, and it's not the leader in this space. It's not the worst, right? It's not Intel, but it's not the leader. Indie is very small position for me. It's almost play money at this point. It's I love stocks, so I like to have fun and own a few stocks, but it's not a conviction. It's not a very strong conviction, but I put a little money in it just for fun. What Indie does is They do entertainment system, they do LiDAR system, they do ADAS, and frankly, my only appeal in Indie Semiconductors is the valuation. Right, you have a stock that's growing at 103%, 47% gross margin, which is almost, I mean, it's getting close to AMD at least for a teeny tiny company. That's impressive, and their valuation is they're cheap at a 0.2. So the valuation is really the appeal for me for a company like Indie. You'll find that Love is the same story when I talk about Lovesac. I'm really neutral, but the valuation is so good I can't ignore it. Moving on to my ad techs. So as far as ad tech goes, of course, moving back to the revolution. So what is, because these are all mega trends, right? We went to payments, right? Payments is the end of cash. E-commerce is the end of retail. Cybersecurity is the end of the security guard, right? Healthcare is the end of legacy healthcare. This is the end of oil and gas. What is ad tech? Well, ad tech is one of these older disruptions for now, but really advertising used to be a billboard on the side of the highway. It used to be in the newspaper, and of course today advertising is online. It's worth mentioning that the biggest player in advertising is unequivocally Google. Google is number one by far, far. But you also have to buy everything else in Google. And therefore, it's tough for Google to move the needle, which is the reason why I am looking for players that are more specialized in advertising. I have two players, Pubmatic and the Trade Desk. Pubmatic is a sell-side platform. So that means it is publishers, people that have space on their website, that sell that space to Pubmatic, and Pubmatic sells it to buyers. So Pubmatic is a sell-side platform. Very interesting positioning. They are building their own cloud and their own servers, so they have a little bit of debt, and I'm careful about that. And the valuation is okay. The issue with Pubmatic is that the growth has stalled because, of course, in 2022, with all of the talk of a recession, the first things most companies cut advertising. And that's a similar pattern that you find for the Trade Desk. The Trade Desk was growing much faster. Their growth has stalled a little bit because companies are halting their advertising campaigns right now. The Trade Desk, though, solid company, great reputation in the space, great niche in the space, and they are a buy-side platform. And a lot of people love the Trade Desk anymore. This is a stock that has had an outstanding long-term return. However, quite expensive per my spreadsheet. But you see, the Trade Desk in its field is the leader. So paying close to a 1 or a little bit above 1 for the absolute leader in your field is a good thing. And Google, remember that Google is heavily driven by its own properties, right? So there is some competition in advertising, right? It's not Google owns everything. There is competition. It's a complex landscape. Moving on to my lifestyle stocks. So really quickly, why do I call these lifestyle? Well, new brands are a thing today. We are seeing a lot of old brands die as the new world of digital entertainment and digital and digital everything, just about digital life, is coming of age. We are living in a digital life. Once you live in a digital life, your brands are going to change. The brands of the 20th century were created through evening news and television, and only the big industrial corporations could pay millions of dollars to get campaigns to get in front of 100 million eyeballs, undifferentiated. So if you look at all of the old brands of the past, of the old lifestyle brands of the past, let's say, famous example is say a Tide, like Tide laundry detergent, that was a brand, a lifestyle brand of the past, or a brand of the past. A brand of today, Coca-Cola is another example. Coca-Cola is a brand of the past. Today's opportunity is to create new brands because there is a new medium of advertising, and you create your brands mostly through advertising. So anyways, I have 3 what I call lifestyle stocks, but I could call them marketing stocks or brand stocks. I have 3 stocks that I find very interesting, piggybacking on this mega trend. So the first one is Celsius Holdings. Celsius Holdings, if you live in the US, if you've lived in the US for the past 3 years, you've probably seen this product catch every single grocery store, convenience store by storm. It's just about everywhere in the US right now. And it's growing at 68% over next 4 quarters. A lot of analysts estimate. They have a partnership for distribution with Pepsi. The forward gross margin is 42%. They have a very youthful marketing, a very sports-oriented marketing. They have a more gender neutral marketing also, say, than a Monster beverage. And really, Monster is really the playbook by which I analyze Celsius Holdings. If you look at the annual returns of Monsters, at the compounded average annual returns of Monster beverage over the past 20 years, you can see it's been absolutely outstanding. And it's one of the top stocks to have owned. It's possible that Celsius follows a similar pattern. And I was in Europe last week visiting family, and when I go to stores here and there, Celsius is nowhere there, but Monster is everywhere. But Celsius is nowhere, Monster is everywhere. So if Celsius Holdings is capable of replicating what it has done in the US, in other major parts of the world, Asia, Europe, Latin America, if they're able to do that, this is a company that could have a really, really long growth runway. And of course, advertising today is made easy and is made flat because we live in a digital space, and the concept of distance, the concepts of culture merge in a digital space. So that's why I love Celsius Holdings. I think it's a great company. I've used the product quite a few times. I think it's a great product. I think it tastes better than a lot of alternatives. Problem is the stock is a little expensive right now. But we'll see. We'll see. Maybe we get a pullback opportunity. Moving on to now a very cheap stock, which is Lovesac. So Lovesac is the same story, but for furniture. And I'm interested in Lovesac not because of the product. I mean, it's one lifestyle stock out of many lifestyle stocks. In a nutshell, what Lovesac does is what they do is the way I describe it is that the 20th century generation had lazy boy recliners and these big bulky sofas, and the 21st century generation has bin bags essentially, or modular furniture. So they're going after furniture that is more modern than the more legacy furniture, and of course they're doing that based on modern methods of advertising and modern methods of selling. I mean, we see all the distinction in selling and in lifestyle stocks. For example, one of the main features of a lifestyle company is that you'll have a showroom, right? It doesn't matter where you buy in the showroom or not. You'll have a showroom, right? If you go buy furniture at a legacy company, like say a Lazy Boy store, you walk into the store and you're assigned a salesperson, and that salesperson is going to follow you everywhere. Right, just even the mode of selling, and think about how the youth today views how they buy, how they communicate, the significance of a buy now button, the significance of being able to buy on your own without feeling any pressure. Right, these are all things that these companies embody. Anyways, the reason why I love Lovesac, and I want a little bit of it, is the valuation. The valuation is dirt cheap at a 0.09, and the only way I can describe why this valuation is so cheap is because, and I'm going to be facetious a little bit here, is because, real estate is dead. Nobody's going to ever buy furniture ever again. That's probably what the market is thinking. Real estate is dead. We're not buying furniture ever again. That's obviously not true. That's obviously not true. Furniture is still going to be a thing. Nesting is still going to be a thing. Couples who get formed, who move in together, are always going to want to buy new furniture. It's part of life, and so I'm not as extreme as to say, that's going to disappear. I think that's a silly statement to make. Moving on to Figs. So Figs, again, lifestyle brand. This time, the playbook by which I analyze Figs is Lululemon. So if you look at Lululemon, they popularized the yoga pants in an era where it was weird to wear those, the late 90s. And they made it a fashionable trend. So much so that they're probably one of the most knocked off piece of clothing out there. And of course, the stock has an outstanding return well above 30% by look for. And Figs is trying to do the same thing with scrubs. So scrubs, right? Medical sector, you wear a lot of scrubs. Figs is trying to use the same playbook that Lululemon used for yoga pants. It's trying to use that for scrubs by making scrubs, attractive, not one size fits all, but one size fits many, comfortable, etc., etc. So you're betting on a new category of clothing, which I think is very interesting. Even if you go back a long time ago, think about a company like Levi, right? Levi's jeans was an incredibly popular company because they introduced a new form of clothing. And clothing is one of these things, like furniture or like beverages or like food, that are too human, too biological for us not to buy, right? It's very, very tough to disrupt that. And Figs is trying to introduce a new category in the form of scrubs. And when I did a bunch of videos actually on Figs on this channel, there's many people that have told me, oh, well, I use my scrubs when I do this or when I do that. Like some people use them for gardening. Some people use them for walking out. Some people use them just to be casual in the house, right? So when we see the prominence of yoga pants today, while they wear this obscure piece of clothing that you would only wear in a studio in the 90s, it's easy to understand how something like jeans became very, very, very popular, and it moved way beyond blue workers, right? I mean, most jeans are not sold to blue workers today, to blue collar workers. So is it far-fetched to think that maybe 20 years from now, maybe scrubs are not sold anymore to just medical professionals? It's a bet. It's a tiny position. The growth has stalled, but I'm not holding them accountable for the growth stalling here because it has to do with a healthcare being in a boom year back in 2021, and of course we're going through a very slow year right now. Secular trend nonetheless. So these are the companies that I follow. There's many more lifestyle stocks, and I want to cover more of those because, again, the 21st century brings opportunities for new brands. We've seen many new brands come, and there will be more new brands that replace the old brands. And that's disruption right there. That's mega trend. That's product adoption. Moving on to cloud. And of course, I love Microsoft Azure and GCP and AWS, like the next guy. But these are amazing products. But these are stuck within huge conglomerates, right? If I could only buy Microsoft Azure or AWS, perhaps I'd be more interested, but you can't do that. I mean, you absolutely can't do that because you have to get the whole behemoth, right? So you have to get the search engine for Google, and you have to get the logistics set up for Amazon and the e-commerce website for Amazon. So you don't always necessarily like everything. If you want to just invest in the cloud, which cloud is still a very current megatrend, right? Cloud megatrend really started the first half of the 2010s is really when we started that big time adoption of cloud. So we're still early on in the adoption of cloud. And when I look at, say, DigitalOcean and Axon, I put them both in cloud. So what is DigitalOcean? What they do is they allow small businesses and developers to have cloud setups, like tiny cloud setups for a small business, for a small company, without a big bill, without a huge bill from AWS. So AWS, Azure, GCP, they've become so big that really, if you're a small business, you really can't be a customer because the pricing is not made for you. DigitalOcean is creating pricing for small business to also use the cloud. Of course, enterprise spend is a little down right now, so the growth is only 25% over the next 4 quarters, but I believe it will pick back up. I mean, this is a mega trend, as mega trends gets. Margin is excellent at 61%. Axon, so you may be surprised why I put Axon in a cloud niche. The reason why I put Axon in a cloud niche is because they've done different products, but really the product that they're focusing on now is digital cameras for police officers. Whenever police officers say pull someone over, they turn on the camera. That's a lot of data. That data is stored somewhere in Axon because it has built a relationship with police stations all across the US through its other products. It's able to now upsell a cloud video storage system and cloud evidence management system, etc., which makes this company very interesting because obviously manufacturing cloud services, manufacturing providing cloud services is much more profitable than manufacturing, say, cameras. So that's why I love Axon. And right now, these stocks valuation is really right in the middle, really right in the middle. So it's like I have time to add to these. I think it's really right in the middle valuation. Moving on to neobanks. Oh, neobanks are dirt cheap. They're dirt cheap. Even if you take into account the recent run in both of them, they're still pretty cheap, right? So you have Nubank and SoFi. I mean, really briefly, I'm always torn between both of those. Right now, Nubank is a bigger position for me, and I own more Nubank than I own SoFi. The reason for that is because I am uneasy about the presidential campaign coming and the student loan issue being brought back to the forefront. That makes me uneasy. I could easily see primaries and someone say, "Oh, we're gonna do a student loan moratorium again," and then here we go again, and SoFi is again losing 2 years, being tortured by money managers that are like, "Oh, it's a student loan story." So I want this stock to not be a student loan story anymore, and it will eventually. I mean, eventually it will. Eventually, the market will realize it's absolutely ridiculous. Eventually, right? Anyways, that's just a point. I mean, for the longest time, you had people who still believed Amazon sold books. Like I remember 2015, 2016, you had analysts who were like, "Oh, it's just an online bookstore." In 2015, 2016, right? So how long is it going to take for SoFi for people to realize, oh, it's not just a student loan company? I think we may have a few years to go, which is why I have more time to add. But I love SoFi. SoFi is, of course, a neobank. They're focusing on more affluent Gen Z and millennials. You bank with your app. It's just an app. It's a very highly rated app, and they are a leader in the US in the neobank sector. They're a leading neobank. They really are the leading neobank, bigger than Ally. And Ally, like if you were to compare SoFi and Ally has other issues. Like Ally was a spin-off of General Motors. There's other issues in Ally. When you look at the debt of Ally too, it makes me uneasy. So that's why I wouldn't touch Ally. But I do love SoFi. I think SoFi is a great company. Then you have Nubank. Nubank is the same story, but it's a bigger company because it's more advanced in its thesis. And what they do is Nubank is a neobank in Latin America. They're extremely big in Brazil. Huge amount of customers in Brazil. You have more than half of Brazilians who actually use Nubank. Nubank is a holistic bank where you can do just about everything from your app. And the reason for the popularity, of course, of Nubank in Latin America versus SoFi is because SoFi has to fight to get customers away from traditional banks and to get them to sign up for SoFi, right? You still have inertia from traditional banks in countries like the US. In Nubank, you had a lot of people who did not have bank accounts in the case of Nubanks. In Brazil and Mexico, you have a lot of people who still don't have or never had the opportunity to have bank accounts, right? And in the US, unbanked, I believe the unbanked in the US is something like 7%. So huge runway, huge induced demand, new demand, easy sell for Nubank. It's an easier sell when you're a bank. It's easier for you to sell your services to someone who has no bank than to someone who's been using the same bank for, say, 10, 20 years. So that's why SoFi is having to spend quite a bit more on customer acquisition than Nubank. Nonetheless, I love both companies. I'm more bullish on Nubank right now. Moving on, and by the way, neobanks, I'll just finish. Neobanks, of course, the bet is the end of a branch. That's that's how I describe it. That's the end of the branch. No more branches, everything digital, everything online, because with the disappearance of cash, of physical cash, you really don't need to pay, 7,000 branches in the case of Bank of America or 5,000 branches in the case of Chase. You don't need that anymore. You don't need that anymore because an app can do the same thing. Moving on to platforms, and I'll finish with this. Platforms, fascinating business model. Probably as good as SaaS, if not better than SaaS, because on platforms, you don't even make the product. It's, your sellers sign up and your customers sign up, and it's a virtual sloop. The more sellers you have on the platform, the more buyers come. Sellers equals buyers. equals sellers equals buyers equals sellers equals buyers in a loop, in an endless loop, and then you end up with near monopolies, right? So it's how companies like Airbnb got so big. Airbnb has more rooms than all of the hotels in the United States combined, and it's never owned a piece of real estate, right? It doesn't even have a headquarter. Airbnb, if you follow Airbnb, their management is fully remote and they live on Airbnb full time, and that has been kind of the story of the company since the beginning. Anyways, so Airbnb is a very interesting company. The growth has stalled a little bit, but it will pick back up because we've had a lot of pent-up demand, and of course a lot of people were traveling, and now they've traveled. So let's wait a little bit. And there's shifts in travel, and I've covered this in a recent Airbnb video as to why we see just a little slump right now, and shifts in trend. Like, for example, a big shift in trend right now for Airbnb is cities are becoming popular and countries not as popular as before. So that's like a trend. But these are trends in traveling. Airbnb, it's a multifaceted company. There's a lot of things to say about Airbnb. In a nutshell, I would say that they want to revolutionize rental real estate in general. It's bigger than just hotels. It's they want to revolutionize how people that don't own homes live. That's what they do. And if you look at Airbnb, you know that about a quarter of the people on Airbnb have long-term, more than 28 days bookings, right? So you have people who live on Airbnb, right, who find it very, very convenient, right? You just sold your house. You don't want to commit to a new lease for 12 months. You're just going to do an Airbnb for 2 months while you figure it out. Right, a lot of people who get started in life. You go into a new city, you got a new job. What are you going to do? Are you gonna commit to a lease for 18 months? Or are you just gonna rent an Airbnb for 2 months and figure out the town before you buy? There's a lot of good things going on for Airbnb. Induced demand on travel. A lot of people will book travel on Airbnb, which if Airbnb did not exist, they would have never booked this travel. So that's induced demand, right? Whereas in the past, you only had hotels. If you only have hotels and you're a family of 7, good luck traveling. It's not going to be very good. But all of a sudden, you see Airbnb, you can rent you a full house. Then you say, oh, that's an amazing deal actually for me. So that's the beauty of Airbnb. There's a lot of induced demand. You know, I love this business. Not worry, I don't have, of course, the free cash flow numbers and the EBITDA numbers. I don't have any of that in here because my style of investing is focused on growth, growth, growth. But if you had this in here, just know that Airbnb makes a lot of money, and you have a lot of value investors who are getting very interested in Airbnb right now because of the cash flow and because how much money they make. I have 2 more platforms which I do not own, but I really want to own them, but I don't own them. It's Etsy and Fiverr. The reason why I don't own them is because the growth is a little too small for me right now. Etsy, and Fiverr are both still suffering from the boom years that they had in 2020, 2021, where people were at home, right? A lot of people stay at home. They're like, okay, I'm going to do crafts and try to sell it on Etsy, or I'm going to sign up on Fiverr and try to do some work on Fiverr. Nonetheless, I believe they're leading platforms in their respective fields. The induced demand that Etsy has created for homemade custom craft goods is impressive. I mean, it's a business that didn't exist at all, and they made it exist. So it's a 0-to-1 move in my view. And Fiverr is kind of the same way. The way they've approached, I believe, the division of labor, the way they divide labor, with the whole, oh, it's only $5 with like $5, and of course most jobs cost way more than that now on Fiverr. But the way they divided it, the way they made it appealing, compelling to both sellers of labor and buyers of labor on that platform was also very, very unique. And the beauty of platforms is that you have network effects, and once you have big network effects, it's nearly impossible to compete against these companies until, of course, the trend goes away or a new technology comes. But as long, take Airbnb for example, as long as people are going to be renting things, That's, I believe, going to be a very tough moat to beat. That's going to be a very, very, very tough moat to beat. So I am done with this video. I hope you really enjoyed it. This was not investment advice. This is just entertainment. I typically do this video on Fridays, so I'll get back to my Friday schedule. But appreciate all of your likes. I appreciate it, and I appreciate your subscriptions, and please subscribe. Have a wonderful day.